Hello and welcome to the second of the three videos which make up this quarter's investment update. In the first video we looked at what an extraordinary time it's been in the economy, with inflation and interest rates going from pretty much zero to very, very high levels in a very short space of time. This video is going to look at what impact that has had on some of the various different asset classes that we can invest in. And then the third video will look at investment performance and some of the changes we've been making to try and adapt to some of the opportunities that we see are out there. Now, one of our core beliefs in investing is diversification. Essentially, don't put all your eggs in one basket. Make sure that we spread the risk and invest in lots of different asset classes, because often when one or two asset classes are falling, hopefully one or two should be doing okay. Maybe they're flat, maybe something is going up. But by diversifying and spreading the risk, we can hopefully smooth the journey. Now, unfortunately, in 2022, that diversification didn't really help very much, as nearly everything we can invest in fell at once. So we're going to look at 2022 first for context, and then we'll look at what's happened so far this year. So the chart on screen looks at the returns of various different asset classes in 2022. This is a non-exhaustive list of some of the things we might choose to invest in. And in 2022, you can see only one of these asset classes made money, and that's the FTSE 100, which is large UK companies. And that's because it has a high weighting to oil and gas companies like BP and Shell, who benefited from the rising energy prices after the war in Ukraine. Now, all of the other asset classes on this chart lost money. In equities, the riskier areas of the market, such as smaller companies and technology stocks, were hit hardest. But in a way, more challenging for portfolios were actually the losses outside of equities. And here we saw some very, very big falls in some of the other asset classes that usually provide that cushion when stock markets fall. So for example, gilts on here lost just as much money as tech stocks. And corporate bonds weren't much better. Real estate was actually the worst of the lot. So there were very few places to hide back in 2022. And the primary cause of all of these falls in asset prices was mainly the rise in interest rates. And as we looked at in the previous video, the rise in interest rates was very, very sharp, and it was done to combat that sharply rising inflation. And this was really caused by what happened in the pandemic. And hopefully we're not going to see something similar again. So hopefully we won't see such a big impact. But rising interest rates in particular is bad for bonds, but it's also bad for certain types of stocks, those where the growth or the value is based on expectations of future growth rather than what profits they've made today. So 2022 was a very difficult year. 2023 has been a little bit different. In general, 2023 has been a much better year for equities, or at least certain types of equities, but it has continued to be a struggle for other asset classes. So the blue bars on this chart now show 2023 returns up to 5th of October. The red bars are still 2022. Now, large cap equities have generally done quite well so far this year. The FTSE 100 there is up, and so is the S&P 500, the main US market, has done relatively well. But you can see smaller companies and emerging markets have lost money again this year. Away from equities rather, gilts and real estate have actually gone down for the second year running, and corporate bonds have only been just about positive. Again, with rates continuing to rise this year, this is what's had a very big impact on these asset classes. Now, the standout performer on here has actually been US stocks, and they've done far better than most other stock markets. And in particular, you can see the Nasdaq index of mainly tech stocks has bounced back very, very sharply from the lows of last year. Now, in context, if you'd have been in 100% Nasdaq over both years, you'd only be just about in positive territory. But recently, you can see they've done extremely well. So the reason that US tech stocks have done so well this year has largely been due to the advances in artificial intelligence. So many of you will have read about ChatGPT, perhaps you've even used it yourself. And investors are very, very excited about the potential that AI might increase the future profits of some of these big tech stocks. Not so much what's happening today, but very, very excited about what might happen in the future. And therefore, the share price of some of those big tech stocks like Microsoft, Google and Nvidia, who make sort of processing chips, have done very, very well this year, so far this year. Now that expected profit growth really does need to materialise, or we could see some very, very disappointed investors in our opinion. Now we bought a Nasdaq tracker during the lows of last year, but in many of the portfolios we sold it completely after a very, very good run. But those few big tech stocks have actually driven nearly all of the returns of the US stock market so far this year. Now, when we look at a market index, what we normally do is we look at it in what's called a market cap weighted index fashion. So essentially, when you look at an index, it's got a bigger proportion in the bigger companies and a smaller amount in the smaller companies. So, for example, the top 10 of the S&P 500 accounts for about 30% of the index. So the blue line on this chart shows the US market in the way that we normally look at it, that market cap weighted index, but the red line instead shows those same 500 stocks, but this time equally weighted, so the same proportion in each company. And what this chart shows is that whilst the market was actually well up this year, the average stock is actually down. And the gap between the two is really quite remarkable, given it's just the same 500 companies weighted differently. And to illustrate just how remarkable that is, I thought I'd look back in history and look at what has happened to these indices in the past. So what this chart shows is every calendar year going back to 1999, which is as far back we can take the data. Again, blue is the market cap weighted index and red is the equal weighted index. Now normally the gap between the two bars is pretty small. Equal weight has actually won more often than not, so the red's been higher than blue in 15 of the last 24 years. But in 2023 so far, as we saw, there's a 12% gap roughly between the market cap weighted index doing much better than the equal weighted one. And I'd like to just highlight the last time we had such a big gap. If we zoom in on 1999, during what we now call the dot-com or tech bubble, the blue bar was about 10% higher than the red bar. But as you probably remember, the tech bubble burst and you can see that the blue bar fell in the subsequent 3 years. And what I think is quite interesting is what happened to the equal weight index, so the red bars. They actually continued to make money in 2000 and in 2001, even when the market cap weighted index fell. So we see a few echoes of 1999, with the market being driven by a very few number of stocks in a specific sector. In 1999 it was the internet that was driving, or hype around the internet. Today it's hype around AI. Now the internet did change the world, but if you'd invested in 1999, then you probably would have been very disappointed for a very long time. We wonder if the same might be true investing in AI stocks today. We see those echoes of 1999 and we are slightly worried about that and therefore have been reducing exposures to some of those big tech stocks. Now we often say we believe in weighting portfolios more towards smaller companies and less towards the large ones. Clearly that wasn't the right strategy in the past couple of years, but over the longer term the data shows this tends to be the right thing to do. So if we look at cumulative performance of these indices, since 1999, the equal weight index in red has returned not far off double the market cap weighted index. Remember, these are the same 500 companies, just more in the smaller ones and less in the larger ones. And essentially, smaller companies have more scope to grow than large ones. If we look at Microsoft, it's over $3 trillion in size. That is more than the total value of the companies in the FTSE 100. It's very difficult for a $3 trillion company to double in size, for example, because they would have to add as much value again, more than the total value of the FTSE 100. Even a 10 billion company, fairly large company, could double in size much more realistically. So that's one of the reasons why we always tend to put more money in small cap stocks and a bit less in large cap stocks, because typically over the long term it works. So in summary, it has been a turbulent couple of years for lots of different asset classes. 2022 was an awful year, whilst in 2023 we have seen recovery in certain types of equities, but it's actually been confined to a very small area of the stock market. However, we do now see many signs that interest rates may now have peaked. We see that inflation is starting to fall, and therefore we think what might happen in the future could be very, very different. We're very, very positive about the returns of certain asset classes, in particular bonds, where the fall in price means the yield has gone up, and that means the future expected returns have gone up. But we are quite wary about some of those big tech stocks that, in our view, now look really quite expensive. And in the next video, we'll look at what impact all this has had on portfolios and what changes we've been making to try and reduce some of those risks, but also capture gains, capture opportunities for the future. So thank you very much.